Welcome to the Deep Dive. We're your shortcut to understanding what really matters in, well, today, a set of earnings reports. We're digging into Crown Holdings, Inc.'s Q2 2025 earnings call and their press release. The goal here is to really unpack what's behind their, frankly, surprisingly strong performance. How does a company in what seems like a pretty straightforward industry, packaging, manage to do so well against some complex economic headwinds?
Yeah, that's a great question.
So our mission today, figure out what fueled that strong second quarter for Crown. Where are they seeing growth? What challenges are they up against? And, what does it all mean for them and maybe the wider packaging world?
And you used the right phrase there, surprisingly strong. Because looking through these reports, the overall feeling is exceptionally positive. It's actually quite striking for an industry that maybe doesn't always grab the headlines. It really speaks to the resilience, the adaptability of the beverage can itself.
Okay, let's get into it then. Those headline numbers from Crown Holdings Q2 in the first half, they painted a really strong picture. Sentiment aside, what were the actual financial highlights that jumped out at you?
Well, the numbers definitely back up the positive tone. For Q2, their adjusted diluted earnings per share, that's basically profit per share, cleaned up for unusual items, it jumped 19%.
19%?
Yeah, up to $2.15 compared to $1.81 last year. Net sales were also up 3.6% in the quarter, hitting just over $3.1 billion. And segment income, so the profit from their business units before you factor in corporate costs had improved by $39 million. That's about 9%, reaching $476 million for the quarter.
Okay, and the first half.
Looking at the first 6 months, free cash flow, the actual cash they generate after running the business and investing, saw a really significant improvement. It surged to $387 million compared to just $178 million in the same period last year. So a big jump. They also gave back a good amount to shareholders, $269 million through buybacks in those 6 months. And management themselves, they were highlighting record segment income, adjusted EBITDA, and free cash flow, both for the quarter and the first half. The trailing 12-month adjusted EBITDA, sort of a cash profit measure, is getting close to $2.1 billion now. That's up 11% year over year.
Right, those are definitely some robust figures. So if you zoom out a bit, what's the main takeaway? What does this tell us about the health of Crown Holdings right now?
The core message seems pretty clear. It's not just about sales growth. They're showing really strong financial health. They're growing profitably, efficiently across different areas. Seeing big jumps in EPS, free cash flow, EBITDA like that. It suggests they're executing really well operationally and turning that execution into real value and, importantly, returning some of that cash to shareholders. It points to a company with solid fundamentals. And if you break it down by segment, the global beverage business really stands out. Segment income there was up 9% in Q2, and that's actually building on a 21% improvement last year. So, sustained strength. This steady volume growth means their plants are running at really high utilization rates. Plus, they mentioned expecting little direct tariff impact here, which is, helpful insulation.
Okay, so within global beverage, the Americas segment seems like a key driver.
Yeah.
What's particularly interesting about how it performed, say, in North America versus Brazil?
Yeah, Americas Beverage saw a 10% jump in segment income overall. In North America specifically, shipments were up 1%.
Just 1%.
Well, yeah, but that was right on target for their 0.2% growth expectation for the year. And remember, that comes after a huge 9% gain last year. So holding steady after that is pretty good. Brazil also showed solid demand, growing 2%. With this kind of performance, they actually think the Americas Beverage segment income will cross $1 billion this year. It's definitely a powerhouse.
You mentioned operational performance and efficiency driving this. How are they managing to keep margins strong or even grow them in North America, especially when you hear so much about rising raw material costs?
Right. Well, the strong margins come down to running very efficient plants. High productivity, very low spoilage rates. And it's important to understand how they view margins. The percentage margin might bounce around a bit because of raw material pass-through.
How does that work exactly?
So if aluminum costs spike and they pass that higher cost directly to the customer, their revenue goes up. But the profit, as a percentage of that higher revenue, might look lower, right? But what they really focus on is the absolute dollar margin per can, and that's been consistently strong.
Okay, that makes sense.
They also have a bit of a strategic edge because they're underweight in U.S. domestic beer. Meaning they have less exposure to that specific category, which hasn't grown as fast as things like sparkling water, energy drinks, RTDs, ready-to-drink cocktails, which are often in cans. So their mix is favorable.
And the aluminum cost itself, that Midwest premium, is high, right?
It's at an all-time high, yeah.
Okay.
But Crown's contracts are structured to allow for full cost pass-through. So effectively, that cost increase ends up with the consumer. But the striking thing is, consumers haven't really pulled back on buying cans. In fact, Crown even noted the North American market might have done a bit better than expected in Q2, maybe 3 to 3.5% growth, possibly helped by promotions.
Interesting. Shows the power of the can format, maybe.
It seems so.
Okay, let's shift over to Europe then.
Good.
Volume's up 6% year over year, another record income quarter. What's fueling that growth, and are customers still optimistic about cans there?
Yeah, Europe's another strong story. Growth across Northern and Southern Europe, and even quite strong in the Gulf states, and customers. They sound incredibly bullish on cans. It's driven by their own growth, but also this big push towards sustainable packaging. And aluminum fits that bill really well.
So the sustainability angle is key there.
Absolutely. Their long-term outlook is pretty ambitious. They're talking about 3–5% annual growth for the next 15 years in Europe. And they're investing behind that too, modernizing plants in Greece, potentially adding new lines in Southern Europe. And it's interesting, even with some signs of industrial slowdown in Europe generally, the can business doesn't seem to be feeling a direct hit to consumer confidence yet, probably due to that strong substrate mix.
That's quite resilient. But with margins already high, over 15% you said, and growth strong, is there still much room left for operational improvement or margin growth in Europe? Or are they hitting a ceiling?
Well, they'd say there's always more to do. Even though margins are historically high for Europe, they believe in continuous improvement. The plants run well, but they're always looking for ways to squeeze out a bit more efficiency, a bit more output. There is a small difference in profitability with the Gulf states, mostly because those assets are older, more fully depreciated, so the return looks a touch higher there. But overall, yes, high margins, but still aiming for optimization.
Right, always improving. Now, tariffs came up earlier regarding Asia. How are these trade issues actually hitting Crown's results now? Where's the main impact?
It's mainly focused on their transit packaging business, not so much the beverage side in the Americas or Europe. They expect little direct impact there. For transit packaging, though, I estimate about a $25 million potential hit from tariffs. That's split between roughly $10 million direct and $15 million indirect effects. But, importantly, they've already factored this estimate into their revised full-year guidance, so it's accounted for in their outlook.
Okay, so they've planned for it. Let's link that back to Asia Pacific then. You mentioned income decline there, volumes down high single digits. Was that mostly the tariff ripple effect impacting consumers?
Yes, that seems to be the primary driver. Income was down, Southeast Asian market volumes fell by high single digits, and they directly connect that to the impact of tariffs on various Asian industries, which then filters down to hurt consumer confidence and, well, buying power in the region.
A chain reaction.
Exactly. But it is worth pointing out that even with those weak markets, the Asia-Pacific business itself is apparently still operating well, with income margins over 19% of net sales. So operationally efficient, just facing tough conditions. They also took a non-cash impairment charge in China, part of a larger $45 million restructuring charge for the first half, reflecting those market challenges.
Understood. And how about the transit packaging business itself? Signode dealing with both those tariff pressures and the generally softer industrial demand we've been hearing about.
Signode's segment income actually held up surprisingly, well, it was relatively flat compared to last year.
How did they manage that?
Mostly through a combination of increased shipments in steel and plastic strap, plus ongoing cost-saving programs. These factors almost completely offset the weaker demand they saw in their equipment and tools business. So internal actions helped cushion the blow from the softer market.
Okay, so despite headwinds, they're clearly feeling confident enough to raise their full-year guidance. Adjusted EPS now expected between $7.10 and $7.50, and projecting around $900 million in adjusted free cash flow. That's a lot of cash. How are they thinking about using it? What's the capital allocation plan?
They laid out their priorities pretty clearly. Number one is supporting customer needs and grabbing growth opportunities. So it means investing in things like the new production line in Brazil, the modernization in Greece. Their total capital spending for the year is estimated around $450 million.
And maintenance within that.
Yeah, about $250 to $300 million of that is just maintenance CapEx. Priority number two is paying down debt. They're aiming for a net leverage ratio of about 2.5 times by the end of 2025, which is generally seen as a healthy level. And then priority three, which they actually term the number one and only priority right now after the first two, is returning cash to shareholders, primarily through stock buybacks. And with that strong free cash flow forecast, $800–900 million, They feel they can easily cover the $450 million capex and still have plenty left for debt paydown and buybacks. They even said they could certainly afford to spend another $100 million on growth projects from time to time if needed. Shows flexibility.
Definitely sounds like a strong financial position. So looking ahead, what about inventories? And what's the general feeling about 2026? Are they expecting this strong run to continue?
Inventory levels are interesting. They said their inventory is actually no higher than it was at January 1. In fact, they mentioned they probably have a few hundred million less cans in inventory than we would like right now,
Hmm.
which tells you demand is strong and they're running lean.
So they need to build stock.
Exactly. They plan to build some more inventory as we get into Q4. Why? Because they do see a very strong 2026. Based on what customers are telling them about their own growth plans and upcoming contracts, Crown thinks next year could be a very tight year capacity-wise for them, but also a very good year as well financially. So optimism is high for next year.
And one final point on those strong margins, particularly in North America, how does Crown view their sustainability? Do they see this as a peak, or is this kind of profitability the new expectation?
That's a key question.
Yeah.
Their view is quite firm. They acknowledge that current returns may be higher than it was in the past, but they argue strongly that it's only now beginning to approach what it should be. They really emphasize the sheer amount of capital needed to build and run these sophisticated plants and the operational complexity involved in making cans so efficiently with minimal waste. So from their perspective, these margin levels aren't excessive. They see them as an appropriate and hopefully sustainable return for the value and the high level of execution they provide.
Right, reflecting the investment and complexity involved. So wrapping this up then, what's the single biggest thing that stands out to you from this whole deep dive into Crown Holdings?
For me, it really comes back to that surprising resilience, just
Yeah.
the consistent, strong performance from what many might see as a simple industry packaging. Despite all the global economic noise, supply chain issues, shifting trends, the fundamental demand for beverage cans, especially aluminum,
Yeah.
just keeps proving incredibly robust and allows companies like Crown to just, well, execute and deliver really solid results, almost quietly underpinning a huge part of the consumer goods world.
Yeah, it really does underscore that even with all the economic complexity and changing habits, something as fundamental as the can and the companies making them, they just keep adapting, innovating, performing. It's quite something. It's a blend of meeting basic needs, but with really sophisticated industrial processes behind it. So maybe a final thought for you listening. Next time you grab a canned drink, think about this. In a world focused on sustainability and efficiency, what does the enduring strength of something like the beverage can tell us? What does it signal about deeper consumer trends, or maybe about industrial fundamentals that often go unnoticed? It's kind of a quiet powerhouse, isn't it?